Welcome. This is the ATRAM webinar series. We are about to start in a few minutes.
Do you want to make your money work for you but find investment intimidating? Do you want to build towards a better future? With ATRAM Group's funds, you can invest according to your interests and values. Investing is now made easier and affordable. Step into your future self, invest to reach your goals and aspirations. Matching your risk appetite and investment horizon has never been this easy. Let us help you maximize your earning potential by writing the growth story of the Philippine economy and opening your doors to the international trends in the global markets. Let us prepare you for a better financial future. At ATRAM, we're making lives better through investing.
All right, good afternoon, everyone, and welcome to the highly anticipated ATRAM Market Outlook webinar for the third quarter of 2024. Now, whether you're a seasoned investor this afternoon or looking to gain some valuable market insights, welcome as you're in the right place. I'm Stanley Magno, your host from the ATRAM Channel Management Team, and I'm delighted to have all of you here today. As we look back on the second quarter of 2024, it's clear that the global economy has been marked by uncertainty and a bit of volatility as well. Despite these challenges, the Philippine economy has shown resilience, driven by holding companies and the financial sector as well. As we step into the third quarter, we anticipate a continuation of these trends. The Philippine market is poised for growth, with sectors like property and renewable energy gaining traction. Today, we'll discuss how these dynamics shape our strategies moving forward, and we'll cover key market indicators, sectoral performances, and expert insights that will help you navigate the economic landscape. Stay tuned as we look forward to an engaging discussion, and we look forward to your valuable contributions throughout this session. Don't forget to share your questions with us by clicking on the Q&A button located below your screen and get a chance to win limited ATRAM merchandise. Don't forget as well to stay informed about future events and receive important updates. You can visit our official social media pages by scanning the QR code displayed on your screen. And of course, a replay of today's session is available on ATRAM's YouTube channel, ATRAM Studio. You can also check out our website, atram.com.ph, for more comprehensive information on the market, finance, investments, and the different funds we provide. We'll also have a very quick survey after the webinar. We hope you can share your thoughts about us and today's session and how we can improve our future webinars. Now, unfortunately, due to a few unforeseen circumstances, our originally scheduled speaker, Ms. Sandra Araulio, is unable to join us this afternoon. We apologize for any minor inconvenience this may cause, but we're delighted to have another esteemed speaker with us who has graciously stepped in on such short notice. Mr. Charles Wong brings a wealth of experience and expertise in investments, and we're confident you'll find his insights just as valuable. Allow me to introduce Mr. Charles Wong as the investment strategist and head of business development in our investments team, where he plays an extremely pivotal role in shaping the firm's investment strategies and expanding our client base. He has a strong background in financial analysis and portfolio management, and responsible for implementing prudent investment strategies tailored to each client's objectives and risk tolerance. Charles holds a Master's of Science in Financial Analysis from the Hong Kong University of Science and Technology, and a dual Bachelor of Science degrees from the De La Salle University in Manila. Charles combines academic rigor and practical expertise. With a career spanning various prestigious financial institutions, including Pru Life UK Asset Management, Philam Life Asset Management, and Metropolitan Bank and Trust Company, Charles has consistently demonstrated his ability to drive successful investment strategies and manage diverse portfolios. Now, let's all please give a warm welcome to Mr. Charles Wong. Good afternoon, Charles. How are you doing today?
Thank you, Stan. Good afternoon. Magandang hapon. Ang hapon to all of you. I'm good, and I'm of course excited and delighted to share with each and every one of you, of course, of our third quarter market outlook. No, so back to you, Stan. Or is it my turn?
Right, Charles. We're very excited to have you here today. And without any further ado, please, Charles, take it away.
Thank you, Stan. Hold on, let me share my screen first. All right, so good afternoon. Of course, I'm delighted to be here with all of you. And of course, firstly, at ATRAM, I'd like to thank you also for taking the time to tune in. No? So let's start. The flow of today's presentation will actually be a brief overview of macro, both the US, some parts of global, and then we go to the Philippines, and then we go to the asset classes. And then second on our agenda is we look at risks and geopolitics that may affect both our country and the global sphere. And then lastly, we go with a quick summary as well. So firstly, whenever I look at where the investment horizon is, I always look at the growth rates, no? Which country or which region will be growing the fastest, and that would be the most important place to invest your money. So this one here is a table. If you look on the first column, that's listed all the major regions. So we start with global, regionally, EU, US, Asia Pacific, and then we move on from North Asia down to South Asia and Southeast Asia. No? And then the growth rates from the 2017, and then we have three estimated figures for 2024, 25, and 26. So each column is color coordinated. No? So the dark green ones represent the best in each column, going to light green, and then a little bit of yellow, light orange, and then red is the worst. No? So what can you see? Firstly, global economy, we did see a slowdown or actually a contraction during the time of COVID when we virtually shut down the economy. But then we saw a rapid recovery both in the global sphere and of course, even as Philippines though. One of the things that you will look at or you'll notice here is that on the fourth row, which is Asia Pacific, the growth rates is expected to be much faster than the global average. No? And what we also notice, no? Secondly, in terms of developed countries, the US has been doing quite well post the COVID pandemic year. No? And of course, they are forecasted to grow at 2.3% in 2024. And what else can you notice? Next is in terms of the green boxes, they actually move from the North Asia part, from the middle of the chart, all the way to the lowest part or the lower half of the chart. So it means that growth is actually moving from the North Asia key countries to South Asia and Southeast, which includes us, Philippines, which is we are expected to grow by 5.8% this year and 6% in both 2025 and 2026. So firstly, we move on to the US. So why is the US economy growing so well over the last few years? Number one, deficit spending. So this is on the US government side. On the left-hand chart, you'll see that that's the annual deficit of the US government. So the horizontal line represents 0. And what you can see is that during the last few years, deficit spending, or what they call nangungutang, has been actually hallmark of how the US economy has been functioning. They've been borrowing a lot of money. The only time that the US actually had a surplus was during the period of Bill Clinton. President Clinton, during the time of the late 90s, was actually running a strong surplus. And that's why the US dollar was so strong back then. But rather, over the last 5 or even 10 years, the US has been running deficit every year. And on the right-hand side, you'll see total debt as a percentage of GDP. Currently, it's now running at about 120%. And it's actually expected to dip slightly, but then move even higher in the next few years. No? The only other time that the US debt to GDP was actually this high was during the time of the Second World War, where it actually reached about 108%. And moving on from the government spending deficit to the consumer side. So we here have a chart here. The green line is actually the personal savings rate of each individual in the US, and the red line is actually credit card borrowing. So what can we see? Well, the green line has been steady actually before the COVID years, no? So savings rate have been in the high single digits for the US, and it actually blew up or actually went very high during the time of COVID. Of course, the US government decided to give handouts or give doleouts to each and every family. I remember, I think they gave out twice of $2,400 checks and one more time of $1,200 check. No, so that was a big dole out to each individual. So after COVID, when that dole out stopped, spending still kept going. No, so first they depleted their savings rate, and then when savings was gone, it's now down to 3.2. They wanted to keep that comfortable life going, so they load up on credit card debt. So credit card debt actually surpassed $1 trillion already. And what this means is that, why does consumer have this mentality? Well, they've seen this event happen, no crisis. And of course, during the crisis, they'll say, oh, the government will just give me money, so why not spend it all? I'll do YOLO. So magpapasaya na lang ako. I'll just be happy because the next crisis, government will likely give me more money. But if that happens, or I mean, if something like that happens, it might not be so good. So we'll see what happens. But pretty much this is a high recipe for disaster, no, high debt and low savings rate. Okay, so from there, we move on some of the macro data in the US. On the left-hand side, you'll see inflation. No? So during the 2011 to 2020, just before COVID, inflation in the US, as represented by the blue line, it's actually headline inflation, has been quite steady. It's been averaging between 0 and 2%, or a little, sometimes even a little higher, but it's been steady. Post the COVID years, where a lot of money was given out, people spend, inflation, of course, shot up. So at the highs of inflation, it reached actually 9.1%. That's actually emerging market inflation rate now. No? And even for the core CPI, it's actually 6.6. When we refer to core, it's actually inflation less food and energy. So food and energy generally is the more volatile parts of the CPI basket. No? So on the right-hand side is the interest rates in the US. So the yield curve. No? So 2019, that was the blue line represented down here. Yields were very low because inflation was low. So when inflation spiked up, the US Central Bank, US Fed, decided to increase interest rates. And that's why we can see that the red line here, that's how high interest rates have gone already. No? So it's about, the US Central Bank rate's about 5.25 to 5.5. And what we can see is that the yield curve actually moved from a upward sloping curve to a inverted yield curve. No? So what does inverted yield curve mean? It means that the shorter end, which is here, represented by the 1 month, 3 month, and 6 month treasury bills, is actually much higher than the longer end of the tenors. No? So from the 2, the 5, even the 10. So what does this mean? It means that the economy is actually quite sick. And of course, investors are responding. No? And I'll show you on the next slide what that means. No? So on the chart here, you'll see that this is the difference between the 2-year and the 10-year, what we call the yield spread. And generally, that should be positive, no? Meaning the 10-year should be much higher than the 2-year, but that's not what happened. It's actually inverted right now. So you see here moments in history from 1980 up to now, when that yield curve was actually inverted. And the lower part here is actually the number of weeks that has been inverted. And the shaded orange region here represents a recessionary period in the US. So what does this mean? No? Every time there's an inversion and the yield curve de-inverts, meaning the spread actually goes back to normal, about 6 to 12 months later, a recession happens. So where are we right now? So the curve is actually very near the inversion, with just a difference of 27 basis points. And this is the longest period of inversion in terms of yield curve. No, it's actually inverted for 106 weeks already. So what does it mean? The longer the yield curve is inverted, the longer and deeper the recession is. And of course, right now, as of today, the inversion is just about 19 basis points or 0.19% difference. No? So when that moves back to zero or positive, that means historically, within 6 to 12 months, we'll likely see a recession in the US. So this is something to be watchful and be cautious about. Okay, so from fixed income, we now move on to the US equities. No? So this one is a chart of the S&P 500, how it moves on an annual basis in an election year. So for now, we are actually in the fourth year on election year or a presidential election year for the US. So this chart shows you, for example, the blue line, the number here shows you the number of months that is actually on a positive month. So this is from 1928 to present. So it means that 45 or 46% of the time, January was a positive month in an election year. And the average gain or loss of the S&P 500 during that period is actually 0.02%. So what do we see here? Well, for the US market, the S&P 500 usually have its strongest period during the months of June, July, and August. No? So Q2 going into Q3. And of course, the strongest month is actually August, where 70% of the time, it's actually up. And what we can see is that, seasonality basis, September and October is generally the weakest period for the US stock market. And then going into November, December, we have the traditional Christmas rally. So what does this mean for investor? Well, we are entering a seasonality weak period. So a lot of prices are going to drop. And of course, this is an opportunity for investors to come in, whether you're a short-term trader, you like to take advantage of the upswing in November, December, or you're a long-term investor, which we would recommend as an equity exposure, that it's a time for you to buy into the equity market at a lower price than it was this month or last few weeks. Okay, so from the US, we now move on to Philippines. No? So when you look out on the left-hand side, same concept, same chart as the US, it's inflation, no? Both on the headline and core. So for us, it's more volatile in terms of inflation. The blue line here is the headline, and the red line is actually core, which is less the food and energy component. So same story with the US. As inflation spiked, BSP responded by raising interest rates, and now inflation for the latest figure is actually now down to 3.7 for headline, and now down to 3.1 for core. So it's now firmly inside the BSP's comfortable range of 2 to 4%, which is represented by this red box. On the right-hand side, we have the fixed income side, or the interest rates, or the yield curve. No? So back in 2021, it looks very much normal. It's very low. Post the high inflation period and BSP's aggressive rate increases, where right now it's about 6.5% BSP policy rates. The fixed income side has responded with interest rates high. So what does this mean? Well, number one, for fixed income investors, there's a lot of opportunity in the middle portion of the yield curve, what we call the belly of the curve, holding bonds that are 5 to 10 years out in terms of maturity. Why? Because from 5 to 10, the yield difference is only about 10 to 20 basis points or 0.2%. As compared to, let's say, more than 10 years, the extra risk that you'll be taking for that extra reward is not that much. So there's a lot of opportunity in the middle or belly of the curve for investors to come in and lock in that rates, as we do expect that next year or even the latter half of this year, the BSP will start to cut interest rates. Okay, so this is a chart on the credit side. No? So the green one is actually loan growth, which is right now at 10.1%, the latest figure that is shown. And the other one is money supply, which is the blue line. So why am I showing this? So right now, two things that I have observed. Number one, bank loans are actually responding or actually recovering from the lows we saw back in 2023, where it's just expanding by single digits. Now it's back to the 10% level. No? It's led by consumer loan, which is up 25%, credit card up 29%. But more importantly is the second point, which is the red line here. So BSP started raising interest rates in 2022. That was April, no? But what you can see is that supply side, the money supply, has started to shrink after BSP raised interest rates. But the demand side, which is the credit side, still continued to move higher and only started to decline in December of 2023. Why? it shows you the lag of monetary policy. So monetary policy usually has a lag of between 6 to 12 months. Here, it shows a lag of about 8 months when demand actually started to come down. So what does this mean? So moving forward, when BSP starts cutting interest rates, there's a lag in the recovery of the demand side. Same story, about 6 to 12 months. So when BSP starts cutting rates second half of the year, or maybe next year, then you can expect that there will be a stronger economy or a recovery in the economy about 6 to 12 months later. Okay, so this is a comparison between bonds and equities Filipino. So when we look at, we as fund managers always look at this to show or to look at how attractive each asset class is to the investor money. So firstly is the blue line, is bond yield represented by the 10-year bond yield. And the green line is actually earnings yield. Kumbaga, it's PE that we invert. So telling you how attractive the stock market is compared to the fixed income side. So over the last 13 years, the average spread between bond yields and PSEI earnings yield is actually 1.37%. In periods where the bond yield is actually higher, as represented by these two red boxes, the bond market actually performed better than equity. So two instances, number one, 2017 December to 2018 December. No? So PSEI actually lost close to 13%, while the bond index only lost about 5.3%. Another instance is May 2022 to January 2023. The equity markets gained by about 0.27%, but the bond market gained close to 6%. So currently, the gap of 2.3% actually provides a strong cushion, a strong basis to be invested in equities versus bonds moving forward. Okay, so in terms of seasonality, I've shown you a chart of the US during election year. This is the chart of the Philippine equities market over the last 27 years on a monthly basis. So same story, the figure in the box is actually the average gain or loss of the index during that period. So for example, over the last 27 years, January is generally positive with a 2.5% gain, and it's an ups market 68% of the time. So what we can see from here, the worst period in Philippine equities is actually August, no, where it's only up on average about 30% of the time, and the average decline is about 2.8%. So it presents an opportunity for investors to come in August, moving into the strongest period in equity market for the Philippines, which is fourth quarter, where we can see here, October, November, December, it's all green, and the probability for an up month is actually more than 50%. We even actually have January as another very strong month. So in terms of seasonality, Q3 is time that you should be avoiding the market for those who are actually wanting to trade. But for the investors, Q3 is actually the period that you should be entering the markets. Both if you're a trader, a short-term trader, you like to buy low, sell high in Q4, it's an opportunity. But for long-term investor as well, for equities, it's an opportunity for you to buy the dip and buy something that's cheaper and to hold it for a better price to sell. Okay, more on the equity side now. So this is a valuation chart of where we are right now. So the green line is actually the PE band or the PE ratio of the market. And the black line is actually a PSEI index level. So what we can see, number one, PE has been moving around, let's say, between 15 to 20 times. So this is post the investment grade rating that we received back in 2013. But right now, PE has been very low. It's now down to 10.2. So why is this depressed? Well, on the right-hand side, you'll see the reason why. On the last column, foreign flows have been negative over the last 6 years, starting from 2018, where we got a start chunk of foreign outflow, which is about $1 billion. We then saw another big outflow in 2020, $2.5 billion. But year to date, for 2024, outflow has been about $520 million. But still, the index is positive now. So as long as foreigners continue to sell the market, it will be very hard for PSEI to actually go up. Okay, so this is just a regional comparison. between Philippines and our peers in Asia and some developed market. No? So for June, Philippine market was down about 0.3%. The color scheme are the same. So green one's the best, the red ones are the worst. Year to date is as of July 12. No? So Philippines, we are close to the lower end of the ranking. No? We are just ahead of Thailand, which is negative 5.9, and Indonesia, which is only up positive 0.8. Of course, the varying performances is also led by the US, which is up 23% for the NASDAQ, S&P 500 up 17. Of course, Japan and Taiwan doing well as well. These are mostly reflected by, number one, the strength of the AI plays in both the US and Taiwan. And of course, in some ways, Japan also benefits because of the weaker yen. So in terms of currency, it's inverted. No? So the green one means they are performing the best. And of course, positive means depreciation, negative means appreciate. Sorry. Yes, correct. Positive means depreciation and negative means appreciation. So back in about a month or 2 months ago when peso was hitting 59, a lot of us were wondering what's going on with the Philippines. No, it's actually not a Philippine story. It's more of a regional story. When you look at our peers, Thailand and Indonesia, their currency also lost 6% and 4.8% respectively. The same way with Taiwan and Vietnam, also seeing more than 5% losses in their currency. In terms of valuation PE, Philippines, we are at 10.3, which is much better in terms of comparison with our peers, and even much better than our 10-year average of 15.3. Okay, in terms of individual stock performance, you'll see here all the 30 names of the PSEI. PSE, the index is up 3.1. So these are the best performing ones. You can see most of them are the telcos, the banks, and some service sector related companies like ICT. No? So these ones are done. We're not going to look at that, but we focus on the right side, which is the laggards, no, where opportunities lie. For us, we're actually looking positive on the stocks that did quite poorly, especially the property sector and some select consumer names, which we believe is a case to be invested in right now when inflation is coming down and interest rates are also coming down. Okay, so just to present the other macro factors, no, that we also look at. Number one, car sales. The last figure of June saw a 7.6% increase year on year, no, which is quite remarkable, you know, looking at in terms of how car sales are performing when interest rates are so high, still able to perform at a positive year on year growth. No, on the right hand side is electricity demand, although this is mainly for Luzon and Visayas, but it reflects how well the economy is doing and is usually a leading indicator for GDP figure. No? The last read that we saw is actually up 11% in terms of electricity sales. Okay, apart from that, just to flag some highlights on President Marcos' recent SONA. Number one, which is the most important one, he did instruct the PAGCOR, or Philippine Amusement and Gaming Corp, to actually ban all operations of POGO and to have them wind down by the end of the year. So currently, the estimates are about 22 to 25,000 Filipinos are currently actually working in POGOs. And the office sector exposure of listed companies, although still positive, it has already come down quite aggressively. You know? So when you look at all the listed company, only Megaworld is the one with the highest in terms of exposure to on the upside of 4%. Of course, there are other companies like Double Dragon who has exposure, but these are for the main ones, the big ones. And of course, Lee Chu company has also estimated that about 1 million out of 18.2 million floor area or gross leasable area is POGO occupied. On the residential side, it's really hard to tell because we don't really have reliable data on that. But as with offices, we already see a lot of the listed companies have wind down their exposure to POGOs, and likely it would follow the same trend as the office side. So the other thing that we also wanted to highlight on the President's SONA is actually on the foreign relations, though, where he ordered his military team to actually de-escalate the tensions while they maintain a firm stance on Philippine rights and sovereignty, which is good news. No, we always want harmony and peace between us and our neighbors, so that we are able to focus on the economy and also growing the relationship we have with our neighbors. Okay, on the risk and politics side, so number one, I flagged the presidential election for the US this year. So today, we now see what happened on the last few months now. So number one, President Biden has already dropped out of the presidential race and endorsed VP Harris. No, on the left-hand side, you'll actually see former President Trump post the attempted assassination on him, which of course will show you on the right-hand side how that has affected the polls. No, so right now this is the polls or what we call the betting average for who likely will win the elections if it was held today. Red line here you'll see is former President Trump. He's now at 58.4%, and right now Vice President Harris went from 0 all the way to 29.7. No, post the endorsement from current Biden. No. And the other one is the risk of armed conflict of China and between Southeast Asia. So I'd just like to offer you some views on this one. No? So this is a map, Google map of us in Asia, but I was actually just turning it around on the perspective of somebody sitting in Beijing. So assuming I'm the president or the prime minister, this is how I look at the world right now. And by God, if I'm the president or prime minister of China, when I look to my left, it's allies of the US. When I look to my south, it's Philippines, Guam, and Hawaii, also allies of the US. Even on my southwest, there are some US bases in ASEAN. No? So the X rectangle marks the area of conflict, which is right now most likely South China Sea. And of course, for somebody sitting in Beijing, waterways is the most important navigation area, no, when in terms of trade, because number one, by land is actually very expensive and slow. By air is also even more expensive but fast. But trade by waterways is the cheapest and most efficient way. And right now, for me, China, most important is to keep my waterways open, and that is why it's an armed conflict between China and the Philippines is unlikely to happen. In terms of the perspective of the Chinese, they do not want war in the same way that we do not want an armed conflict too. And therefore, our conclusion is that the conflicts or armed conflict between us and Beijing has very, very low probability. Okay, in summary, so US markets remain resilient despite macro variables showing slowdown. No? So current earnings season needs to show strong growth in both revenues and net income. And of course, also positive forward guidance. Though currently, valuation has been quite aggressive. It's actually hitting the upper end of the limit line. It's right now, price action is also pointing to short-term volatility. But we do expect that post-election, there will be an equity rally by the end of the year. So opportunity is also presenting itself in the bond market, as investors start to price in US rate cuts by second half of 2024 and for 2025. So Philippine side naman, the macro conditions have been improving as inflation recedes and our currency stabilizes now. So growth is expected to plateau from the current level, but is going to move higher for next year and 2026. No? So right now, Philippine bond remains quite attractive with rates at 5-year high, although it is forecasted to move lower in the next 2 years. The Secretary of the Department of Finance, Secretary Recto, has also said that interest rates will come down by 100 basis points in the next 2 years. So there's an opportunity in the bond market in that terms. No? So that is coming to getting controlled. So our debt to GDP ratio right now is 60% and should come down and provide cushion to the currency. No? So right now, the government actually needs new policy to push growth higher and increase dollar inflow. Currently, we have OFW remittances and PPO, but the third leg tourism needs to come in to help support and grow our country. So that's it from me. That's the end of my presentation. So I now return the floor to Stanley.
All right, Charles, thank you so much for that comprehensive interview and for generously taking the time to highlight both the market landscape and the potential opportunities for our audience. As we all know, and you just discussed, it's a period marked by several things like inflation, a differing regional and global performance, few extended rate cuts, and a bit of political risks as well. So we hope our audience has come out of this with a few insights and to help navigate our markets as well. And to our audience, please don't forget we have a Q&A bar at the bottom, so please send in your questions. I'm sure we want to take this chance and to take advantage of our live Q&A later with our investment expert, Charles. So Charles, thank you again. And while you're filling in your questions to our dear audience, I'd like to share some exciting news from ATRAM in 2024. This year has been exceptional for us, marked by several prestigious awards, recognizing our commitment to innovation and excellence in asset management. So ATRAM was actually named Asset Manager of the Year by Fund Selector Asia, underscoring our dedication to outstanding client outcomes and setting higher industry standards. We were also honored with the Market Awards of the Philippines by Asian Investor, the leading asset management company in the Philippines of 2024 by the International Business Magazine Awards, and the leading asset management company and wealth manager in 2024 by the World Business Outlook Awards, reflecting our team's commitment to superior solutions. Now, our innovative approach received accolades such as the leading innovative asset management company in 2024 and the most innovative fund management firm in 2024 from the Global Brand Ambassadors and the Cosmopolitan and the Daily Business Awards as well. Now, these achievements also underscore our commitment to sustainable investing, highlighted by the Mandate of the Year from the Triple Asset A Sustainable Investing Awards in 2024. We want to owe this success to our dedicated team who continually push the boundaries in the investment industry. We extend our heartfelt thanks to our clients and partners for their unwavering support. Rest assured, we're committed to excellence and innovation as we redefine the asset management and fund management industry. Thank you, audience, for being a part of our success story. Now, I'm sure everyone's excited for this section, and we're opening the floor for our live Q&A session. Please feel free to send in your questions to the chat bot. As we're answering the questions, you can also continue to add more questions. So our speaker, Charles, will be happy to address them. Kindly give us a moment and we'll check in on our questions now. All right, we have a few coming in from our audience. Thank you for sending them in, and please feel free to send in some more. Charles, we have a few questions here, and the first one coming in.
All right.
You discussed earlier about this anticipated rate cuts. The question one is, how will the anticipated interest rate cuts be impacting the Philippine market?
Well, so let's start with each asset class now with the bond market first. So bond market, we do expect the rate cuts coming in. That should help support the bonds. Of course, for those who are knowledgeable or those are familiar with bonds, it moves inverse to interest rates. So when interest rates come down, then bond prices will go up. So right now, the DOF secretary is actually looking at, he did state on news that he is looking at 150 basis points of rate cuts. So that's 1.5% reduction in the BSP rates. So when that goes in, bond markets will respond. And of course, the holdings of your bond in terms of its value will go up. Of course, not by the same magnitude. There are calculations to be done, but means that's a positive for bond prices. On the other side of equity, of course, the interest rate sensitive portion of the equity markets will help. So number one, the property sector will of course benefit from there. Lower interest rates means people are able to borrow more. And of course, on the consumer side then, lower rates means economic activity goes up. And this also will permeate throughout the economy, and which for us is a consumer-based country with about 70% spending in services and consumption. That would help, of course, the consumer companies.
All right, thanks for that, Charles. These interest rate cuts have been on, I think, a discussion since last year as well. And
yes, correct.
Thanks for sharing that insight and helping our audience navigate through what is ideally to come in the next few months as well. All right, we have another question coming in, and I think This has also been, I think, a point of discussion, um, definitely more on the US side. And you did show a few slides on it earlier. How might the economic policies proposed by the leading candidates in the 2024 US presidential election influence global financial markets, but particularly in Asia and emerging economies?
Okay, so we'll start first with former President Trump. He is the one who's more vocal. The Democrats side, they're still quite quiet on their policies. But let's start with former President Trump. So number one, more tariffs. He did say that he will impose 60% tariff on all goods imported from China and 10% on all goods imported elsewhere. No, so it means higher inflation for both the U.S. and us because it does come permeates throughout the global economy. Number two, more spending. So the Trump tax cuts that was started back in I think that was 2018, will expire by the end of 2025. So there is an expectation on his side that those tax cuts will be extended further. So it means more deficit spending for the US, which I already showed the chart. The deficit is already historically at the highest level already, as we've seen. No? So it does mean that there will be more money printing and likely will lead to higher prices. No? Nextly is pivot away from clean energy. No? So President Trump has already stated before that he favors the traditional dirty energy, coal, oil, these kinds of energy, and moving or pivoting away from clean energy, solar, wind, and even electric vehicles. So there will be some stagnation in terms of, or slowdown in terms of development as his policies will favor more on the traditional dirty energy side. No? So these are some of the things that we have come to expect. Of course, there will be some more that we will find out as the election draws near or even after the elections.
All right, thank you for that, Charles. Also related is another question we see from the audience, particularly in Asia and the US. Any potential risks to economic growth in Asia and US that we should be aware of as we move into the third quarter?
Well, for now, not much, because for number one, we do still continue to see the U.S. government spend. No, in the latest data that they announced, GDP for the U.S. grew at 2.8%. 0.5% of that is actually government spending. No? So the U.S. government continue to spend, and of course, elections coming around, they are expected to spend more up until October or even November elections. No? Having said that, also we are, however, seeing some weakness in the U.S. macro data, especially on the labor side. No, we are seeing unemployment rate actually creep up slowly. It's now at 4.1, although it's still at historically low. But we are seeing that slowdown actually permeate and come in.
All right, thank you for that, Charles. Always important to be aware of the risks when investing in any asset classes. For the third, no, sorry, we're already on our fourth question, and we see a lot more coming in. Audience, please keep sending them in. Number four, how do you think the political landscape leading up to the elections will impact market stability in the Philippines specifically during the third quarter?
So I would assume this is referring to the US. No,
Yeah.
let's use that one. Well, right now, not much. No, we still haven't seen the summary or actually the whole policy, seeing more effect of that once the election finishes. So there will be a lull moment between the end of the election, which is about elections is November 5. So for the US, it's all usually done in about a week. So there will be a lull moment between the second half of November and December up until proclamation in January. So during those 1.5 months, we'll see more pronouncement or policies to whoever wins the presidential seat in this election.
All right, thanks for that, Charles. And coming, at least this is more in retrospective, another question from the audience. Considering the recent rally in global equities, what do you think has been the main driver behind this trend, especially in the US and Philippine markets?
Well, for one, we do continue. We actually saw accelerating earnings. Number one for the U.S. tech companies, no. So what we refer to the Mag 7, although in terms of earnings accelerations, only the Mag 6 Tesla has been weakening, but the other six, due to strength in the AI team is actually doing quite well in terms of revenues and income, most especially NVIDIA, where earnings actually grew by 6 times, or about 700% over the last 12 to 18 months. So that said, that those earnings are actually quite supportive to the US equity markets. But right now, over the last few weeks, we're actually seeing earnings broaden out to not just the tech sector, the Magnificent Seven, but it's actually moving into the other sectors of the economy. So it's earnings season now, so we'll get more clarity as the earnings season move into high gear this week. We're in actually for this week, we have 3 of the Mag 7 reporting earnings. So we'll be able to see how that has helped in terms of earnings for in the US.
All right, it looks like an exciting week for the equity market.
It is actually.
All right. A lot of questions coming in from our audience. Another one coming in also in the US political side. What could be the impact, Charles, for a Trump win on the policy outlook for both the Fed and BSP, if possible? Thank you, Charles.
Well, for one thing, we already know that President Trump made his money in real estate. So it begs to differ that for him, a lower interest rate environment, or actually even zero interest rate environment, is actually quite beneficial for him. So likely we will see interest rates come down. Of course, there's independence between the president and the Fed chair. But of course, walls have ears, walls have mouths. There will be whispering, murmuring behind. And of course, there will be pressure on the Fed to actually lower interest rates. But the same story also applies to BSP. So since we are pretty much anchored to the US interest rates, the BSP will follow suit. So right now, our inflation is getting under control, which is a good job on our central bank. But once the US starts cutting rates, there will be actually that incentive for the BSP to actually also follow suit, lower interest rate, and allow our economy to actually grow or accelerate in terms of growth again.
Perfect. Thanks, Charles. And the next question coming in from the audience is very much related to that. In the Philippine space, will the continued decline in inflation have a significant effect on the consumption in the Philippines?
Oh, definitely. For us in consumer, the one thing that we are always worried about is rising prices. Yes, true, inflation growth rate has been coming down, but when you look actually over the last 3 years, prices cumulatively actually went up by more than 50%. Before, when you used to go out to dine out with your significant other, generally you'll be spending about 500 to 600 pesos per person. Right now, when you go out, at minimum, you'll be spending maybe 800 to 1,000 pesos already. So as people are able to adjust to that higher level of prices, which takes time, then of course people can spend more once prices stop moving higher. And of course, we also cannot emphasize the second, inflation. So when you look at inflation, let's say umakyat itong prices, itong presyo ng bigas, presyo ng bilihin, it affects other aspects of the economy as well. And the number one aspect that gets affected is wages. And of course, once inflation starts with its second and third round effects, it tends to become permanent. Especially, example is wages. When government increases minimum wage, hindi mo na mamababawi yan. That's it. Diba? Right now, it's more than 700 pesos already minimum wage per day for NCR. You can't go back to the previous level. So, that's why inflation is very toxic in terms of how it affects consumer spending. And it's very important for government to have stable prices, which allows consumers to, number one, save, and number two, anticipate their spending. If it keeps going up, then you'll be saying, isa-save ko na muna to because I want to know what will happen. As compared to, I know chicken prices or presyo ng bigas will be this in the next 1, 2, 3 years. I can plan, let's say, my other spending, especially discretionary spending.
Yeah, thanks for that, Charles. And I don't know about you, but I felt the sting in my wallet the past few years also.
It's painful. It was painful. Mahirap na yan.
All right. We have last three questions coming in from the audience, and thank you everyone for your questions. It's been a very active webinar. For our eighth question, is the peso expected to appreciate in the coming months once the direction of rate cuts becomes clearer?
Yes. So currently our macro fundamentals are quite solid, no? So it's just that because US has been so aggressive in raising interest rates, the exchange rate actually followed suit. It's more of a story of a strong dollar rather than a weak peso. And right now, with the US actually expected to cut rates second half or even next year, then it relieves that pressure for us as an emerging market ASEAN country, no? And it, of course, it also alleviates pressure on the currency of our neighbors as well, no? As the table I've shown you, it's not just the peso that has depreciated by 5%, no? Other currencies in our Asian neighbors have actually shown 6% depreciation for this year. So it is really a story of a strong dollar. And hopefully that with US interest rates start to come down, then at least that would give us breathing room for our central bank to adjust interest rate policy. And that likely would also help or relieve pressure on our exchange rate.
All right. Thanks for that, Charles. And for our second to the last question, it's also on my mind as well. What sectors, Charles, do you think will be moving faster and more favorable for next year?
Well, for us, we are quite positive on the property sector. No? So, of course, there are some short-term headwinds in terms of POGO exiting, but that then number one, exposure is quite low already, and number two, that would be the end by the that would finish already by the end of the year. No? So there are opportunities for buyers to come in, lower housing prices. Oh, I'll be happy to buy a house or condo at lower prices. But of course, it provides the legs for markets or property market to do well next year, as it now moves from the hands of foreigners to locals who are actually using those housing or property in a productive manner. No, of course, the other one is as inflation comes down, consumer companies would do well. No, some of the big companies like URC, Jollibee, or even Mondanisin, who have seen their costs skyrocket over the last 2 years, are now able to manage those costs and a steady stream of income come in. No? So these are some of the sectors that we believe would do well in the coming 12 to 18 months.
All right. Thanks, Charles. And for our last question today, thank you again to our audience for sending these in. This time, bonds are seen to perform well because of interest rate cuts. Now, Charles, on the Philippine equity side, since it's still not performing well, can you see it as still a good time to invest in equities? And
Yes.
do you have any
Okay, sorry.
idea? It's quite a long
Excited,
question.
sorry.
No worries. Thank you also to our audience member who sent this in. Do you have any idea on how longer we should wait before equities go up?
Well, firstly, the answer is yes. We are at ATRAM. We do still look at we still have a PSEI year-end target of 7,400. No, so currently the level of 6,600, you still have about 800 points upside, 700 to 800 points, which is a good return. No, that's roughly close to about 10% return from where we are right now. But of course, with the seasonality chart that I showed you, we do expect some weakness, no, coming in August, because it's also the start of the ghost month. No, so just to remind everyone, ghost month of 2024 starts August 4 and ends on September 3. So generally, this is the weakest period for Philippine equities for any calendar year. But of course, on the flip side, it presents opportunities for investors to come in, to be able both as a short term to ride out and enjoy a higher price towards a fourth quarter, where we see traditionally the strongest quarter for the Philippine equity, and of course also for long-term investors to come in and to buy at a lower price than what we have right now.
Charles, thank you for that. And unfortunately, dear audience, that's all the time we have for questions today. But before we end this Q&A, Charles, do you have any final thoughts and insights that you'd like to share with the audience?
Well, number one, so macro, there will always be ups and downs, no, in any economy. So generally, we just have to be watchful of that. But more importantly, for investors, especially for equity investors, time in the market is much more important than timing the market. No, investing is always going to be a long-term endeavor. It always requires careful planning, and of course, it also requires each investor to work with their broker or financial planner, or even for ATRAM. We are open. You can consult us for any of your investment needs. We stand ready. Send us an email, call us, or send a text message to your favorite salesperson. We'll be glad to answer any questions. And of course, as investment professional, always be careful, no, in terms of the landscape.
Thank you again, Charles, and we're looking forward to more opportunities to learn from your expertise in the future.
All right. Thank you, Stan. So thank you very much, and thank you to everyone.
All right. And now for a comprehensive overview of all the funds we provide and opportunities to take advantage of the insights you learned here today, we invite you to explore our website at atram.com.ph. Feel free to visit for more detailed information. And did you mention that you can start investing for as low as 1,000 pesos so you can jumpstart your investment journey? Here's how you can invest in ATRAM funds.
Good day! If you are interested in investing with ATRAM, the leading independent asset and wealth management company in the Philippines, please visit our website, www.atram.com.ph. We have all the details you would need to know about our funds. If you would like to start investing, click Invest Now. For further assistance and account opening, you may email our client services team. If you have more questions, visit the website's Frequently Asked Questions page or ATRAM Academy page. We hope this helps. Thank you.
Apart from that, we also have ATRAM Prime. ATRAM Prime offers access to a diverse array of investment options. These options empower you to tailor your portfolio according to your specific goals and risk tolerance. Committed to long-term growth, ATRAM Prime's expert fund managers utilize proven investment strategies, guiding you towards the creation of enduring wealth. For more detailed information, please refer to the video displayed on your screens. If you want to learn more about ATRAM Prime, we invite everyone to download the app now. You can scan the QR code on the screen or visit our website as well. Now, once again, kindly take a moment to visit and scan the QR code on your screen to access our official social media pages. You can catch a replay of today's session on ATRAM's YouTube channel, ATRAM Studio. You can also check out our website at www.atram.com.ph for more comprehensive information on the market, finance, investments, and all the funds we provide. And lastly, we would greatly appreciate if you could participate in the survey at the end of this webinar. Your thoughts on today's topic are very important to us. And on behalf of everyone at ATRAM, thank you for attending today's session. We extend our best wishes and continued health and safety for you and your loved ones. Have a wonderful day.